Alright guys, so OPEC Plus just unleashed hell again and we are moving closer and closer towards a global crash. Putin and MBS have once again extended their oil cuts, and this isn't good for the world with major economies already in recession. OPEC Plus is pushing their oil cuts further down the road and Russia is joining in. Putin is going to cut production now, and this is quite a U-turn. Collectively, they are going to keep the 2 million barrel a day cut until the end of June. When OPEC cuts production, we need to pay attention. They are doing it for a reason and it's not because they want to earn less money. OPEC is cutting production because they are preempting a crash in demand going forward. But here's the crazy part. By cutting production, they are feeding into a crash. Japan and the UK, they are in official recessions and Germany is next in line. The world's biggest consumer, the US, is also importing less. In 2023, America's total trade deficit fell by 19%. This is a big change that shows the US is starting to import less stuff versus their exports. The value of imports overall fell by nearly 4% last year. And this trend is sweeping across Japan, the UK, and Europe. People are simply buying less. And when we look at the Chinese data, it confirms that the world is importing less and global trade is in big trouble. China's PMI shows the world's biggest manufacturer is still in borderline contraction for nearly 12 months. It has been bouncing around 49 for nearly a year. Beijing is the biggest exporter of goods to the global economy. A contraction here means that global orders across the board, they are all dropping. And when demand for goods drop, the need for energy supply is also going to fall. There's a direct connection here. OPEC extending the oil cut is front-running the coming recession. Russia joining in the cuts is an even bigger confirmation. And by all measures, Moscow should be selling more barrels to fund the war. But why are they cutting production now? Because they want to milk whatever revenue is left from the economy before the collapse arrives. Oil production cuts are still an effective weapon because energy demand is inelastic. There will always be a baseline of oil demand no matter how bad things get. You can have 10 million layoffs tomorrow, but life still goes on. The demand for energy won't suddenly disappear. You still need to put gas in the tank. You still need to keep the lights on and turn up the heat during winter. By cutting production now, you ensure prices stay high. Since late last year, oil prices have been going higher and higher. And that's why we saw a rebound in inflation readings for December and January. Energy is getting more expensive again. OPEC's strategy to boost their oil revenues is working. It's keeping oil prices higher even though global demand is dropping. And this is the very definition of supply side inflation. So why are Russia and Saudi Arabia cutting? And let's start with Moscow first. They will be reducing output by 471,000 barrels a day. That's nearly half a million. But take a look at the specifics of the cut. Russia splitting the curbs between their production and exports. In April, Russia's cut will comprise 350k of production cuts and 120k of export cuts. And by June, the curbs will come entirely from Russian production. And this is quite an important detail. By exporting less in April and more in June, Russia expects to overcome the crackdown from the G7 sanctions in just a few months. And by June, the cut will be fully from production, and this will have a greater effect on the price because it hits directly on the supply and demand equation. And this is the tricky situation Russia is in. They need to keep oil prices high, but they need to export crude to the world for their war chest, all while dodging Western sanctions. And a big part of this cut is to placate the Saudis. MBS needs to keep the price of oil high because things aren't looking very good in Saudi Arabia. They are in an official recession because oil prices came down hard last year. Q4 GDP came in at minus 3.7%, while Q3 fell by 4.4%. So the Saudis are extremely motivated to cut production to drive prices higher. If they can cut production by 2% to send prices higher by 5%, that's going to be an overall win for them. MBS is trying to move towards a future away from fossil fuels, a push towards non-oil industries. And if Saudi Arabia is to survive decades from now, they have to diversify away from oil and gas. And that's why he's spending a fortune on a spending spree to invest everywhere. Saudi Arabia's deficits has been mounting for many quarters. It was a surplus in 2022, but because of higher spending and lower oil prices last year, they fell into a deficit once again. Q3 saw a significant deficit of $10 billion. But here's the catch, MBS can't stop spending now. He needs to modernize the Saudi economy at all costs. So he has two options here. Either he borrows more money at high interest rates, well over 6%, or he cuts oil production to jack up revenue. And it's very obvious which he prefers, extending the oil cuts and getting Russia to cut more as well. According to Fitch, Saudi Arabia needs to keep oil above $90 a barrel in 2024 and around $85 per barrel in 2025 next year. That's just to balance the books. If we count in the investments from their wealth fund, it could rise well above $100. So until prices hit that threshold, we can well expect oil cuts to continue well past June this year. Saudi Arabia is pushed into a corner. If oil prices don't go above $90, they will face a big fiscal problem. Debt to GDP will hit 28%, going up by 2.5% last year. To fund the budget deficit, the Saudis have to borrow more money. And the final domino is spending in 2024, which is going to be 3.5% higher. So we can expect MBS to force OPEC to maintain the oil cuts all the way until December. He will keep trying to defend the oil price. But who's going to be the biggest loser here? And let's talk about that. When energy prices go higher, there are three clear winners and one big loser. The first two winners are, of course, Saudi Arabia and Russia, the ones doing the cuts. MBS gets to balance the budget and Russia gets to fight on for longer. Their revenues go up. And this might surprise you, but the US won't be the loser here. They won't really be hurting. Because of the oil war with OPEC, America is now a very big oil producer. Since 2010, US output has been ramping up from 5 million barrels a day to over 13 million barrels in 2023. So US oil sales are benefiting from the oil cuts. When OPEC ramps up production cuts, US producers get to sell at a higher price. Production has fallen back down to 12.6 million barrels in January, but most of this volume stays within the US itself, so inflation can be controlled to a certain degree. The biggest loser, once again, is Europe. Because of their location and all the embargoes against Russian oil, any supply cut will hit them the most. India and China won't be suffering because they are buying energy from the Moscow discount store. In other words, the production cuts are going to drain the wealth of the Eurozone even further, and this money will be flowing to the rest of the big economies. It's not just money leaving Europe, but the industrial base as well, especially Germany. German factory stagnation deepens as activity unexpectedly goes down. Well, this isn't unexpected at all. It's written into the stars, it's etched into stone. The German PMI fell to 46.1, worse than expectations of 47.5. Energy prices in Germany are just too high. Production orders are dropping and their industries are contracting. It's so bad that the economies of Germany and France are starting to diverge away. As German industries keep crashing, France is slowly recovering, and it all has to do with energy. Around 70% of French energy comes from nuclear power. They are well diversified. Conversely, 70% of Germany's energy mix comes from fossil fuels like oil and gas, so any production cuts will hit them the hardest. Even within Europe itself, there are many different levels of losing, and Germany is right at the bottom tier. New orders, both domestic and foreign, are crashing to hell, and this is causing a consistent decline in German output. It kind of makes you wonder if they can even embrace a war economy. Churning out weapons still needs a big industrial base if civilian manufacturing is collapsing. Trying to make weapons will also be a big problem, a big headache, and it's all about cost, and they're simply too high here. German automaker Mercedes is predicting doom and gloom for many more years. They are cutting back on their EV sales targets because production costs won't come down. The global economy is slowing and energy prices in Germany will be stuck there for a very long time. So margins for Mercedes-Benz are going to come down, and if this continues, German automakers will move their factories directly to the sources of cheap energy with markets that are still growing. Germany will continue to deindustrialize while helping China and the US to industrialize. Oil production cuts don't just make prices higher, they directly wreck the industrial base of Europe as well. They are triggering a big exodus out, and Germany is freaking out. They are now planning a rescue package to save their economy. But something tells me this just won't work. Germany is preparing a 7 billion euro tax package to prop up the economy, but this won't be nearly enough. Reducing the corporate tax burden is one thing, but it still doesn't solve the big problem of higher input costs. The German economy is on the highway to hell, and unless they get off the sanctions bandwagon, all these are just stopgap measures that only look good on paper. It looks good on paper, but in reality, it doesn't really work. Here's how useless the package will be. Even if it works, it will only equate to 0.16% of German output. Economists say that Olaf Scholz needs at least 30 billion euros to move the needle. And if that's the case, why is Germany throwing spaghetti on the wall? Well, it's because they are losing badly in the polls. The government is facing a very, very big re-election crisis. The AFD in blue and the Conservatives in black are starting to win more support from the people, while Olaf Scholz's three-party coalition is slumping down with each passing month. And the longer this continues, we could see a collapse in the coalition with Olaf Scholz losing his seat as Chancellor. So the level of desperation is starting to mount. It's one big song and dance, one big smoke and mirrors. The 7 billion euros is more political theatre than real economic rescue. The only real way to restore hope is to end the war and restore cheap Russian gas. However, that is impossible today. But how long can this last? Manufacturing is around a quarter of Germany's economy. When your industrial output keeps collapsing and companies keep moving away, this will impact jobs back home. Germany's unemployment rate is starting to hit back up to the 2020 levels. Since Russia-Ukraine started, German unemployment has risen from 5% to 5.9%, almost 6. Jobless claims have also increased by 11,000 in February, and this is going to crater domestic demand and spending power further. Fewer people will be buying stuff from German companies. In fact, they will be importing more cheap stuff from China because prices there are still going down. Beijing is still exporting deflation to the world. With OPEC and Russia cutting production till July, this is going to ramp up the pain even further. Economic recovery won't be coming for a very, very long time. Many companies are already planning an exit away from Germany. The French tire maker Michelin is shutting down two of their German plants and downsizing a third one by 2025 next year. And this will affect at least 1,500 jobs on German soil. People will be losing their careers. Why stay in Germany when your input costs are just so much higher? Plus, you still need to export the goods out of Germany into other markets. You make a car in Germany like an EV, you still need to package it up and export it out to the US and China. You are just piling on more burden after burden. And we have arrived at a point where we can't export truck tires from Germany at competitive prices anymore. This is the top complaint from Michelin. And this sums up the entire crisis Olaf Scholz is facing. All the green policies and all the diplomatic disasters, the choices are now manifesting in real time. And here's where things get crazier. Even if Germany wants Russian gas back, it's very unlikely Putin will lend a helping hand. And there's an even bigger scandal today that threatens to push Europe, the entire of Europe, into a regional war. Russia has released the infamous military leak that involved German generals planning to strike the bridge in Crimea, and this is going to torpedo any remaining relations between Russia and Germany. And it gets worse. Germany calls this part of Russia's disinformation war to destabilize the Western coalition. But how can it be disinformation when even the Germans themselves didn't deny the phone call? They even confirmed the leak was authentic, calling for an investigation. So at this point, it's hard to imagine Moscow restoring relations with Germany. Cheap Russian gas might be off the table forever. Russian supplies have been completely diverted to Asia, and it will be likely stay that way for a very, very long time. So the takeaways are very clear. Oil cuts are going to put more pressure on the global economy, and it's going to make a recession more likely, and the biggest loser in this is once again going to be Europe. But as always, let me know what you think. Will OPEC cut even further in June? And can the German economy be saved? Let me know in the comments below. Stay safe, take care, and I'll see you soon.